So what's the difference between OpEx versus CapEx?
So usually when companies are budgeting or fat forecasting for the year, a lot of their cap expenses are considered business equipment purchases throughout the year that they have the ability to make within a certain window of amount of money. Operational expenses are things such as payroll, ongoing needs. Right now, PPE needs to be added to that because customers and companies in general have these new expenses that have come about because of sanitation, hand gloves, testing, you name it. A lot of times companies run out of their capital expenses. And what we can do is come in and help if, for example, a need arises that wasn't planned for or forecasted in their budget, we can move a lot of their, line items from CapEx to OpEx by providing lease terms, breaking down their payments and throwing it onto that line item where they might have a little bit more flexibility than they would on the capital expenditure side of the budget.
So I know that you offer a lot of different products for your clients, and I know two of those are fair market value and EFA, which is equipment financing agreement. Can you tell us what's the difference between the two?
Both products we can do anywhere from 1 to 5 years, and we can also put your payments on monthly, quarterly, or annual payments. So a lot of flexibility initially right away. If a customer or vendor partner is looking for something outside of that box in terms of maybe 38 payments, 42 payments, for whatever reason, the finance department wants it, we can do it. But for the most part, we're putting payments on monthly, quarterly, or annual payments for both products. If we're speaking on your equipment finance agreement, ownership of the equipment is with the customer. At the end of the term, the customer holds ownership at the end. There isn't a dollar. They don't need to worry about what the value of the equipment is at that time. They own it outright, right? So that's simple, very straightforward. That's, again, our EFA, our equipment finance agreement. What we're seeing in-house is a lot of companies are taking advantage of our FMV, or our fair market value product. What that does is that affords you the flexibility at the end of your term to return the equipment at that time, purchase it at the fair market value, or continue to lease it at those lower monthly payment rates that you're going to get considering in relation to our EFA. Is specific to IT, it makes a lot of sense for most of our companies that we work with to take the FMV option because technology advances over the course of 3 to 5 years tenfold. You stay away from obsolescence. You're going to need upgrades anyway. So having the flexibility of those three options to return it to us, we got to deal with it, to purchase it at the fair market value, or continue to lease until you figure out what you want to do, can really support and continue to support the growth of the companies that we work with.
Are the the payments the same for a fair market value as opposed to an equipment finance agreement?
No, the payments are much lower on the fair market value transaction. And
they are, okay. Okay.
I've seen as low as negative 12% interest rate on a fair market value transaction. Typically, EFA, it's going to be, you're going to start at around 4 to 5, maybe 6%, and work your way up from there. Whereas FMV, because it is a true lease, you can get a much better rate.
And we have an amazing credit and risk team here at Blue Street that does a lot of research. I will say there are a few factors in determining what your FMV lease is. One big one is the actual equipment that's being leased. We have tier 1, tier 2, tier 3 products. Obviously, if it's a tier 1, as Mike spoke on, you're going to see rates that are going to be in the negative, and a lot of companies have been shocked at some of the prices that we can get for them on FMVs. Which is a reason that we always push it and present it to our customers as a really viable and strong option to consider.